It was another ugly day of selling here in the United States. In fact, from a breadth perspective, we actually had worse selling today, despite not as bad of a percentage pullback that we experienced on Tuesday. So I'll talk about that a little bit later. We, of course, ended not only the month here today, but also the quarter. And this is actually the first quarter since March of 2020 where the Dow Jones finished in the red. The month of September was not a kind one for bulls. In fact, the only sector that was higher this month here in the United States was the energy sector. So we'll take a look at all of those statistics, see what it means for our current posture. Then we'll get into our trade application example, where I wanted to focus on a short selling situation within the consumer discretionary space. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's September 30th, 2021. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down into our description area and make sure you're signed up for our email distribution list. We're also heavy users of Twitter. My handle is @BrandonVanZee, and if you're not doing so already, I would encourage you to follow me, and we really appreciate those of you that click like and retweet on our Market Outlook related tweets. And then last but not least, we do have a presence on Facebook as well. Feel free to join our group at that web address you see in the logo in front of you. All right, let's dive into today's activity. And I'm going to take a slightly different course or pathway through my video tonight. Wanted to kind of discuss some of the things that are going on this week. As many of you are aware, I try to share my thoughts with you on Twitter throughout the week and also the weekends whenever something catches my attention in regards to the stock market. So again, if you're not doing so already, make sure you're following me. My handle is @BrandonVanZee. If you go to it on the web, you can just go to twitter.com/BrandonVanZee. Anyway, yesterday I posted this, which I thought was kind of interesting, from the Stock Trader Almanac. In fact, I might have mentioned this in the video on Tuesday as well. I know I mentioned it in my classes earlier this week, but can't remember if I did it in the YouTube video here as well. But this is traditionally a more difficult week, particularly today. You can kind of see here, as I mentioned, this is a seasonally difficult week. The last day of September, which of course is today, so I posted this yesterday, but that would be representative of today. The S&P 500 was down 15 out of the last 23 years. And the first trading day of October, which is, of course, tomorrow, the Dow Jones has been down 9 out of the last 15. Keep in mind, the first trading days of most months tend to be strong, which makes October an outlier. And you can see some of that information I've posted here. This comes courtesy of the Stock Traders Almanac, by the way. It's a kind of a little desk calendar, I guess you would say. It does come out every year. So for those of you that like market data and statistics, in particular seasonality trends and things like that, you might look to pick up a copy. I found it to be somewhat useful. But I did find that very interesting, particularly the October part of it, because those of you that have been listening to this video for long enough will know that I've made that comment a handful of times throughout history that the first trading day of the month tends to be a positive one. In fact, the vast majority of market gains throughout history can be directly related to the first trading day of the month. It sounds very peculiar, but if you actually go back and crunch the numbers, there's only 12 first days of the month out there, of course, for the 12 different months, and the vast majority of the stock market's gains throughout history are as a direct result of those 12 days. So normally, if you're sitting on the fence on a day like today, that's the final trading day of the prior month, and you're wondering, should I buy, should I sell? More times than not, falling on the bullish side of the fence tends to benefit you, but October might be that outlier. At least it has been recently in the case of the Dow, down 9 out of the last 15. Tomorrow also represents a pretty important economic day for us as well. It's not just the first day of the month, but remember, the first Friday of the month tends to be when we get some of those jobs and employment numbers that come out, and that has the potential to shake things up as well. Those numbers maybe haven't been quite as impactful more recently, as we've been seeing a lot more government stimulus and things like that, still keeping the economy afloat without necessarily paychecks. Nonetheless, considering the kind of precarious feel that this market has right now, it's something that you want to be paying attention to it, particularly if you're short-term oriented. If you're long-term oriented, you know this is par for the course, which brings me to my next tweet that I posted here just a little bit ago before I went to record, and that is this tweet right here. So I mentioned that less than a month after this tweet, and what I was referencing is the one that I was retweeting down here. So on September 3rd, I said the S&P 500 hasn't had a 5% pullback since October. According to Ally Invest, that's only the 5th time in the last 20 years it's gone at least 10 months without a 5% drop. So I myself have been trading for about 21 years. So in other words, I've only experienced this 5 times in history, what we just went through this summer where the stock market was relentlessly higher. And I say, in other words, investors have had it easy recently. Because of conditioning, the next pullback will be hard for rookies. And I kind of showed here on this tweet, where the last time was that we had a 5% pullback, and that was in kind of October into November of last year. It was the last week of October in 2020. So it's been basically a year since we've had a 5% pullback. That is highly abnormal. Now, I didn't know for certain that it was going to happen in September. That wasn't the reason I posted that in September. But knowing seasonality as I do, it wouldn't have been without, outside of the realm of possibility of it happening in September. So am I surprised that it happened this month? No, not necessarily. So I say less than a month after this tweet, we officially do now have our 5% pullback in the S&P 500. So now the question is, how did you do emotionally? I joke around a little bit here, but I say if you still have a dry diaper, congratulations, and you're now big boys and girls. Keep that composure through any upcoming 10 and 20% pullbacks as well. So again, joking a little bit there, but I do want to emphasize that point that if you were a rookie before now and you handled this 3 out of 4 week stretch with ease that we just saw here, then I think you've got the chops to make it as an investor. On the other hand, if you were frazzled and panicking and pulling your hair out and couldn't sleep during this 5% pullback that we have here, then you got work to do. Doesn't mean that you can't overcome your difficulties. It just means that you've got a little bit of work to do there emotionally. What we've just experienced here is perfectly normal. The abnormal part of this chart was the distance between those two events. Again, only have happened 5 times in the last 20 years. So that part in the middle was the abnormal part. What we just experienced here and what we experienced in October of last year was the perfectly normal part. That is your ticket into the game, right? In order to have a chance at above average returns, you have to have the payment in form of volatility and risk-taking mindset. Similar to if you wanted to go to the Super Bowl, you wouldn't assume that you can just get in for free, right? You have to pay the price to get in. This is us paying our price to have access to some great returns in terms of compared to other asset classes that are out there. The stock market has been proven historically to be one of the best places to generate wealth. So if you've gotten through this far with ease, congratulations, you've made it to the other side. Let's see what the next month brings. It's possible that tomorrow ends up being a little bit more difficult, as we've seen with the first day of October with the Dow, at least in the last 15 years. But keep this in the back of your mind. October oftentimes has a reputation for coming with crashes, but you'll also find that October has a reputation for starting a new bull run. Remember that November, December, and January are typically the year's best 3-month period. So while the first part of October could feel a little bit uneasy and choppy again, you might have a better chance than average of seeing whatever chaos that we're going through right now, finding some stability, and then working off of that towards the end of the year with more bullishness once again. So anyway, wanted to share that with you there. Also, since we're over here on the internet, I might as well get my appreciations out of the way. Thank you to all 104 of you that clicked like for me on Tuesday. Remember, as long as we're getting up and over 100 likes there, I will prioritize doing the video. If we're under 100 likes, then I question whether it's worth it to do the video, since it does take up a big chunk of our time there. So appreciate all 104 of you that did that. Also, while we're over here, a quick view at the factor selector that I posted on our website here a couple of days ago. ago. Momentum, believe it or not, is still maintaining strength up at the top. That one was a little surprising to me. I figured they might drop a slot or two considering some of the selling we've seen here recently, but they had enough oomph over the last 6 months or thereabouts that they were able to maintain that number one positioning. But we did have a big shakeup directly underneath of that. Notice value is surging here all of a sudden. For those of you that are familiar with the different factors out there, you might be aware that the value factor currently contains a ton of financial and oil companies. And so there is probably a smattering of all sectors out there, but there is an abundance of banks and oil companies within the value area. And of course, some of the areas that have worked here recently have been exactly those two areas. Oil and gas companies have benefited from, the oil prices themselves surging higher, and the banks have benefited from interest rates moving higher. Notice who's on the bottom all of a sudden: low volatility. Remember which types of sectors tend to make up low volatility: utilities and REITs. That's also an interest rate sensitive story. When interest rates surge as they have here recently, those bond-like proxy stocks like your REITs and like your utilities that are heavily leveraged as businesses tend to be at the disadvantage. And so we are seeing that play out here in real time. Remember, these are big movements. Value was just dead last year a couple of weeks ago, surging to number 2, and low volatility was just number 2 a couple of weeks ago, collapsing down to dead last. You don't usually see these movements take place so quickly, so it's very obvious to me that the reason behind it is what we are seeing there with interest rates. Also, earlier today, David and I taught our classes. David taught his portfolio management with ETFs class. I taught my question and answer session for my premium members. For those of you that missed that class and want to check it out on our calendar, if you're a premium member, then these are some of the questions that I covered, discussing how do we rank stocks by our WAR score, or the weighted aggregate return score that we use here. My thoughts on MSM, which is a dividend growth stock that's in the industrial distribution business. Also had a question on Fifth Third Bank as a dividend growth investing candidate. Had a question on Spire, a utility company, as a dividend growth investing candidate. Talked about a concept of potentially rotating into other higher yielding companies after certain stocks have erupted higher. So for instance, if you now have a yield on cost of 6%, but the yield on total invested is now only 2.5% in real time, do you rotate out of those to look for higher yielding investments? So I spent a considerable amount of time discussing that thought. And then also had a question on a particular order type that doesn't get discussed a lot. It's called market on close, and whether we can find any interesting trading techniques revolving around that concept. And then also had a question on Salesforce.com as a trend trade. So feel free to check that out. And then tomorrow, David will be doing his normal technical analysis class. All right, let's get back on over here now to the Thinkorswim platform, go through some information and analysis here. So first thing I wanted to share with you was this chart that is 6D, and just like on Tuesday, I mentioned that I like to start with chart 6D whenever we have a big day, whether it's a big up day or a big down day. And today is another one of those big down days. But the view that you're looking at here is a little bit different than when I traditionally give it to you, because this is actually a quarterly view that we're looking at here. So we're looking at 10 years, and the Q here stands for quarterly. So each one of these bars that you see in front of you, the green and the red bars, they represent one full quarter of time. And as you heard me say in the intro, the Dow has just suffered through its first down quarter since March of 2020. And of course, that one stands out like a sore thumb here when you look back over the past decade. This was our big, drop that we experienced, 30 to 35% drop there in a short period of time. But this is a full quarter that you're looking at in this particular case. So as it stands here, I'm using the Dow Jones ETF here, DIA, as my proxy. But we were down about 2% this quarter. So if you were looking at July, August, and September, we were down about 2%. But keep in mind that the last time we were down was March of 2020, and we had all of these gains in between there. So again, stressing that if there's anything abnormal that's going on here, it's the consistency of the gains. It's not the drops that we've experienced. If you were to count this out over the last 10 years, of course, there's 40 quarters involved, only 10 of them were negative quarters. The other 30 were positive quarters. That's a pretty good deal for investors. I oftentimes hear people say, the stock market's rigged. I'm gonna go and invest in crypto or invest in a CD down at the bank or something along those lines. And to each their own if they want to think that way. Far be it from me to try to twist their arm. That's not my job. But I tend to agree with them. I say, yeah, the stock market is rigged, but guess what? It's rigged to the upside. It's just a matter of whether you can control your emotions enough to take advantage of that or not. And so many people get worked up into a tizzy when we have these little market skirmishes along the way that they throw their hands in the air, they give up on the stock market, and what ends up happening? They give up on all of these gains here as well. Look at the price candles up above. Again, these are quarterly bars or candles that you're looking at up here, and look how few red candles we've had to suffer through in the last decade. Now, it doesn't mean that the next decade is going to look identical. In fact, if I were to guess, I would guess that next decade's returns will be less than what we've experienced in the last decade. But it doesn't necessarily mean that I expect negative returns in the next decade. I think you can still end up having healthy returns, even if they're not quite as robust as what we have had the good fortune to have here in the last decade. So if you think long term and you focus on high quality investments and you position size properly and you focus on committing yourself to constantly learning, I think you'll do just fine, and I think you'll improve your family circumstances, compound your wealth, and enjoy yourself along the way. And if you need help with that, of course, that's what we're here to do each and every day at Market Scholars. So you might consider joining us with our premium memberships at some point if you need some assistance with that. Anyway, let's go ahead and take a look at this chart now from a one-day perspective, our more traditional view. And again, it's just chart 6D for those of you that are premium members that have access to our charting package. So when I click on it, it's going to go now back to our normal one-year daily view on the S&P 500, just to give you a general sense as to how today looked. So here is today's red bar here. Again, we did cross below the blue line, and the blue line is the 1% move, and when it's below the black horizontal line, it means it was a negative 1% move. And so remember, when I was with you on Tuesday, we were talking about this one. This one was a fairly rare 2% down day. That had only happened 5 days in the last year. 1% days are much more prevalent, naturally, and so you can kind of get a sense here how many times that red bar has dipped below that blue line in the last year, and it's quite a bit more, just like if you were to concentrate your efforts on the green lines up above. Notice how many of those green bars are hitting that blue line, meaning a 1% up move on the day. So 1% days are pretty common. One thing that I found interesting, by the way, the VIX is still above 20, so VIX is hanging out at about 23 right now. I don't consider that tremendously high, but obviously considering what we've gone through in recent years where the VIX has oftentimes been in the teens, we are at a little bit of elevated level here for volatility as well, at least for the time being. We have seen volatility typically immediately go back down after a quick pop higher. So we very well may see that here within the next month once again, but just be aware of that. But one thing I did find interesting about today's move as opposed to Tuesday's, again, Tuesday was a 2% down day. Today was a 1% down day. But when I come over here and look at the market breadth that I was kind of mentioning in the intro, take a look at this. We had 459 stocks out of the S&P 500 that were down today. Only 42 stocks finished higher here today. The percentage of decliners in the market today was worse than what we saw on Tuesday. So the selling might not have been as bad, but the consistency of stocks that suffered was bad. And we did close basically near the lows of the session to end not only the month, but also end the quarter. So it ended on a very sour note here today. Once again, it feels like we've been kind of fading towards the close, and that's generally not a very healthy sign for the market. Doesn't have to spell doom and gloom for the future, but it just means we've got a little bit of work to do, and the market's just not feeling particularly confident about its prospects at this exact moment in time. But yeah, if you were to calculate this out, it's about a 92% down day in terms of components in the red. On Tuesday, I believe it was at 89%. So from that metric, today was actually more consistently worse from a market cap perspective. If you wanted to see what that kind of looked like on the heat map, here is the S&P 500, and you can see it is mostly a sea of red. We don't have a whole lot of dark red colors, but there's a handful of them out there. Altria Group and Philip Morris, so the tobacco companies, really struggled today, being down about 5 and 6%. You can also see that CarMax really struggled here today, down 12%. And then I wanted to discuss some of these other ones here in the retail space. Home Depot was down 2.5%. TJ Maxx was down 5.6%. Ross Stores was down 5%. Gap was down 8%. And this one right here, Bath and Body Works, we talked about this one briefly in my class today. It's a new spinoff from the Limited Company. It was down 6.5% today, and a big chunk of why this was so bloody here was due to a company that is not even in the S&P 500. It was Bed Bath & Beyond. And I don't have it here, so I can't show it to you, but it was absolutely blitzed here today. A lot of supply chain concerns and whatnot from a retailer's perspective, and I think that kind of bled over to a lot of other retailers really struggling today. So as I mentioned in the intro, our trade application at the end of tonight's video will be to show you how to do a bearish trade on a consumer discretionary stock, and you can see that consumer discretionary was largely in the red today. In terms of who was in the green, remember on Tuesday I could at least say, hey, there was a nice patch of green down below here in the utilities. Most of them were kind of in the green. Today that really wasn't the case. We did have NextEra Energy, by far and away the largest utility. It did finish just barely above break even, but a lot of other utilities were down 1% or what have you, so they didn't really get a chance to try to save the day. Even the oil companies didn't get a chance to save the day like they were able to there a bit on Tuesday. Today it was a bit more sporadic where any strength could be mustered from. We did have EA Sports, or EA Electronic Arts, I should say, the video game manufacturer. It was up 3%. Netflix had a nice day from the FANG stock perspective. It was up about 2%. And then AMD was up about 2%. Paychex, a payroll processing company, was up about 4%. Then there's a dark green one right there, Perigo. They had some unique news regarding taxes that came out. They were up about 8%. So very sporadic and not really any sort of a definitive trend as to what sort of industry group or sector wanted to emerge as any sort of a leader here today. It was mostly a sell-off across the board. Let's look at some more charts now. Coming on over here to chart 4B, this is our market forecast foregrid. And a reminder that the background colors of the chart will change depending upon what the current intermediate posture is according to the market forecast technical indicator that you can find on the Thinkorswim platform. So today we did have some changes to discuss. Remember, when I was with you on Tuesday, both the S&P 500 and the NASDAQ both had strongly bearish postures. So today's continued sell-off should not surprise us that we continue to have strongly bearish postures. For the NASDAQ, we've actually had 2 straight days since then, right? So Tuesday, Wednesday, Thursday have all sold off and closed near the lows of the session. Not a very good feel. You can see that the NASDAQ actually has a red moving average in addition to having a strongly bearish intermediate posture. Notice that that green line is nearly entering the lower reversal zone. You had a decent chance at actually getting an oversold cluster there on the NASDAQ. That's how quickly things can unwind. we had an overbought cluster over here just on August 30th, exactly 1 month ago from today. So we go from extreme overbought to nearly extreme oversold. Not quite there, but who knows? Maybe we get there tomorrow. The NASDAQ was down 0.44% today, so it actually held up a little bit better than some of the others, but the bloody part was what it shares with all of the other indices, which is it closed basically at the lows of the session. So not a good look to end the day. The S&P 500 was down 1.19% today. Similar to the NASDAQ, it has a strongly bearish intermediate posture combined with a red moving average, which says that price is below a falling moving average. That is somewhat rare from what we had been used to and been conditioned to get used to all summer long. Over here on the right-hand side, this is where we have some differences once again today. Not good differences if you're a bull, because on Tuesday when I was with you, we were still barely holding on to weekly bullish postures right there, and then a strongly bullish posture right there on the Russell 2000. Well, a couple of sell-off days where we end near the lows changes that picture. Where we stand here in real time is we now have a strongly bearish posture on the Dow Jones Industrial Average. Notice that dark pink background color, green line reversing below 50 right there. And then we have the Russell 2000 now with the light pink background color, which tells us we have a weekly bearish posture. So that is different than the other three because the green line is rolling over, but it's not quite passing through that indicator's midpoint quite yet. So when you look at this picture, what this is telling you is that of these four indices, it is the Russell 2000 that remains the most resilient at this moment in time. But similar to what I mentioned to you guys on Tuesday, part of the reason behind that might simply be because the Russell 2000 did not participate at the same rate to the upside throughout the summer as the other three, as they consistently were hitting new all-time highs. And therefore, if they didn't go up as much in those final months of that bullish run, then they don't have as much to give back either. So when I look at this, I'm not overly excited about the bullish prospects of the Russell 2000. I consider this to be a sideways chart. But if you're playing the comparative game, then yes, you could get away with saying the Russell 2000 is stronger than the others. It only has a weekly bearish posture, and the moving average is yellow, whereas the other three are red. In this case, the yellow signifies that the moving average is going up, but price is below it, so there's a little bit of a conflict that's taking place right there. So Dow Jones was down 1.59% today, and that was our worst performer, so the blue chips really took it across the chin. A lot of those industrials like Caterpillar and the like really struggling today. And then we had the Russell 2000 down 0.94. All right, let's go ahead and take a look at our three green arrows chart here briefly. And as we look at this particular chart, shouldn't be a surprise to learn that we have three red arrows across the board after today's continued sell-off. We've had three red arrows on the S&P and on the NASDAQ, so it's kind of similar to the bearish posture we've also had on those. But after today, the Dow Jones and the Russell 2000 both have that light pink background color, suggesting that we now have three red arrows on those two indices as well. In the case of the Dow Jones, it was because we got a red arrow there on the MACD telling us that we have a loss of momentum. Same thing happened down below here today on the Russell 2000. And then not only that, but the stochastics reversed lower here, producing a red arrow as well. Same thing did happen below on the Russell 2000 as well. And remember, what that is signifying is that price is closing near the lows of recent price ranges, and that makes sense. We basically closed not only at today's low, but we effectively closed at new multi-month lows on the Dow Jones Industrial Average if you're looking at closing prices, right? We did have a slight intraday low that was lower than today back here on the 20th of September, but the close that we had today on the Dow is actually the worst close on this chart, which stretches back 3 months here. So not a good looking vibe that we have right there. Let's do some 12 grid analysis as well, starting with chart 5A. So as we're looking at this, remember the big storylines that I was talking about on Tuesday, which is the surge in treasury yields. Notice right here that we've seen the TNX absolutely explode higher. Remember, this is not traditionally a chart that you use that term explode with. It's usually pretty boring and puts you to sleep. But we have had an absolute surge in treasury yields here in the last week or so. And while we closed just a touch lower on them today, we still ended at 1.52%, which is effectively at or near a 3-month high right here. One thing that I would point out regarding the long-term treasuries, which was basically flat, it was down 2 cents here on TLT, which was a $144 investment. So call it flat. But yesterday we did print an oversold cluster signal there on TLT. So for those of you that are ambitious enough and feel like this was a little bit more of a move, maybe it was more than your traditional standard deviation type of a move that we just saw here out of bonds in the last week or so, I think there's a decent chance you could get a quick little reversion to the mean type of a move here. So maybe selling a bull put spread or something on TLT could have some interesting opportunity there. We'll just have to see how it shakes out. But I might be brave enough to take a trade like that. So keep it on your radar if you're looking for those types of snapback opportunities. I'm not here to say that TLT will all of a sudden go into an uptrend, but I do think that this was an extreme move that we just witnessed, and it might need to just kind of course correct here for the next couple of weeks. And as long as that happens, then a bull put spread should be able to make some money. Other areas that I think are interesting is down below here. Notice the big move out of gold and oil today. Now, oil is not all that surprising. Remember, oil had already had a bunch of relative strength. I mentioned in the intro that the energy sector was the only sector out of the 11 that was up in the month of September. So we kind of know that that's where the market wants to be right now. So this one was less surprising to me, but gold was a very impressive move. Remember, gold had really fallen out of bed here the last couple of weeks, but it was an interesting setup yesterday. Remember, I wasn't with you yesterday. David was. I'm not sure if he addressed this or not, but had I been doing the video yesterday, I'm sure I would have brought up the fact that yesterday on gold, you had an oversold cluster signal, and it basically lined up perfectly for where this thing bounced back here on August 10th. So this would have been a really nice setup for those of you that were looking for that sort of an opportunity there. So again, hopefully you guys have been well trained and you go through these charts on your own and you know what to look for, right? And this would have been something that, not necessarily predictive, but it's not completely out of the realm of possibility where you might have taken a stab at it, and it would have paid off very nicely today. That's a big move out of gold, up 1.8% there. You can see what that candle looks like. Now, again, be aware we still have that strongly bearish posture on gold, so this is just a reversion to the mean type of a move until you start, finding some levels above the 30-day moving average here. I'm going to assume that gold will continue to either go sideways or perhaps struggle to the downside into the future. Now, remember what I mentioned on Tuesday, which is I got to start keeping gold on a shorter leash because I have an iron condor going on gold right now. And we didn't quite cross our sold strike on the put side here with yesterday's move, but we were right there in that vicinity. And so I, for one, am glad to see this little pop higher, and I hope it can kind of stay in this range here through the next couple of weeks through the October expiration. So hopefully it's got a little bit more where this came from here today. But I, for one, am impressed with that big move out of gold there today, and maybe you're getting a little bit extra opportunities to get that closer to that moving average in coming sessions. Otherwise, it's pretty ugly out there. Again, U.S. dollar is sharing some of the same characteristics as TNX. It was down just a touch today, but remains with that strongly bullish background color there. But otherwise, all these other charts up here, red, red, red across the board. Bitcoin, by the way, was up today. And so that was maybe some sign of life there out of Bitcoin. Remember, there's been some controversy as to whether Bitcoin is a true alternative asset. Does it actually move differently than the stock market or not? What happens more times than not is it seems like it's still a risk-oriented asset. So when growth stocks are up, Bitcoin is up. When growth stocks are down, Bitcoin is down. So today kind of changed that just a little bit. Whereas it had been down in recent weeks alongside growth stocks, today Bitcoin was able to pop a bit higher on a day when growth stocks still struggled. So, maybe some signs of life there in Bitcoin. We still have that strongly bearish posture. We're now down below that falling moving average. So this one's a little bit more precarious if you're trying to take a stab at it at this point. But you never know where this leads. You get some stability here in coming days and weeks, and maybe there's a trade setup waiting for you down the line. So don't fall asleep on it. All right, let's take a look here at our sectors now. This will be chart 5C for those of you following along at home. And you can see it's pretty ugly out there, a sea of red, right? And so every single one of these sectors finished lower today. In terms of who was the best of the lower, let's see if I can find that. It looks like it was actually communications, believe it or not. Communications probably benefited there a little bit from Netflix, and it was only down 0.31%. Also, be aware that despite being, the quote-unquote best today by being down only 0.31%, it did still close near the lows of its session, and you've printed the second straight oversold cluster signal there on communications. Remember, that's a pretty rare event. XLC is a market cap weighted version of communications. And most of you are aware that the FANG stocks have been carrying this market for years. And so it is fairly rare to see communications with oversold clusters. I'm curious, just for my own benefit, what that has looked like in the past. So give me a second. I'm going to right click. I'm going to go to the communications chart and maximize a sell. And I want to go beyond just 3 months here. So I'm going to go back on 6-month daily candle. I still don't have any instances of oversold cluster signals. Let's go back on a 1-year daily chart. Here we still don't. So you can see, and I didn't know this ahead of time. I was just guessing, but it looks like I'm being proven correct, which I'm happy about. Oftentimes I end up with some egg on my face. But you can see how rare this is. What we've experienced just in the last 2 days has not happened in the last entire year for communications. Let's go back a little bit further, because eventually you go back far enough, you should be able to find something. I'm going to have to change this on the time frame from 1 year to 2 years, keep that aggregation period at daily, hit OK. And here we can finally find an example of it. And it happened during the meltdown of the coronavirus. You can see we had one instance of the cluster. So I wouldn't call that one overly successful. I've seen a lot more be much more successful than that. The reason I say that is because you still had a further meltdown. And that is always something you have to be mindful of. Just because you see one example of an oversold cluster signal, it doesn't mean that that is the bottom. The way that I tend to think about it is just going to start the process of bottoming. Now, this was a one-off anomaly, black swan type of event here that a lot of people wouldn't have been able to predict. So I would probably throw this one out to a degree. I don't think a lot of people knew we were just about to have a 35% meltdown in the stock market because of the global health pandemic. So I think you can give them a little bit of slack there, but you did have quite a healthy give back even after that oversold cluster right there. Obviously, within a couple of months, you did unwind that and you would have been bullish to the upside once again. But I hope that proves the point that communications rarely gets sold off, at least the market cap weighted version of it, because of the FANG stocks. So again, some of you might be looking for opportunities there where you're looking for a quick snapback rally in some of those names that are a bit too oversold. In terms of some of these other areas on the chart, you can see that most of our sectors were down over 1% today. In terms of who our worst performer was, it was the industrials. As I mentioned before, Caterpillar, as an example, really got hit today. But XLI was down over 2% here today. You can see that candle looks very ugly all of a sudden here. So let's get into our trade application example now. And for that, I wanted to come on over here to chart 3A. This is our swing trading chart. And I'm going to pull up ticker symbol HRB. This is H&R Block. Now, technically, this is a consumer staple, a consumer discretionary company. I know that probably is a little bit odd perhaps to some of you because you think of H&R Block as the tax company and maybe you think it's in the financials. But technically, as a service company, they do post them within the consumer discretionary sector. And as I mentioned here earlier, the consumer discretionary sector struggled today, largely because of what we saw with retail, right, with Bed Bath and Beyond. But without a doubt, when you are part of a sector, you are oftentimes going to feel either the joy or the pain of others in your sector, regardless, because of our passive nature in this investing world today, where H&R Block is going to be part of the consumer discretionary ETFs, just like your TJXs and your dollar stores and those other companies that sold off today. So whether they deserve to sell off today or not, I'll leave that for somebody else to decide. But what I do think, or at least what I see on the chart, is some weakness here on H&R Block's chart. This is a pretty ugly chart where you're seeing a bearish engulfing candle today. So today's body easily engulfed yesterday's body. In fact, basically engulfed the entire candle there. You can also see that this is a continuation of a downward move that really kind of started in earnest here on Tuesday, the last day that the stock market really suffered. And you can see that where it is struggling is important to me as well, because it's right around that falling 30-day moving average, telling me that it's really struggling there and kind of using that as a resistance area. You'll also notice that down below here, the green line on the market forecast has rolled over. In other words, this is considered a strongly bearish posture according to that intermediate line that we typically talk about in this presentation. And then on this chart here, 3A, because this is a swing trading chart, we oftentimes focus our attention on the near-term line, the blue line in the market forecast as well. And you can see there also, we are considered to have a bearish posture. That's what that light pink background color is telling us there, as the near-term line has fallen down to 15 in the lower reversal zone right now. Now, in addition to that, one other thing did catch my eye with this one, which is we have a bit of a bearish near-term divergence signal. And those exist when you kind of look at a situation like this. So notice that the blue line on the market forecast down below had a peak right here on September 20th. Notice that we had a follow-up peak here on September 24th. Notice that peak number 1 is higher than peak number 2. It's pretty obvious because peak number 1 was in the upper reversal zone there with the pink background, whereas peak number 2 was right here just under the upper reversal zone in the white part of that indicator. Now, at that time where the indicator weakened, notice what was happening up above on the price candles. The two candles associated with those two moments in time were this candle right here, and then also this candle right here. So notice price went up from here to here. Oh, hang on. It's this one. Sorry, I was getting confused there. It's kind of hard to look up and down vertically on the chart there. So from here to here, even though the indicator went down from here to here, what that's telling us is when we open up the hood and look underneath that hood, there is more pressure within the market than is being seen from outside observers. And so that can sometimes lead us to the idea that there's going to be continued weakness that others are not recognizing into the future. So what I ended up doing with this particular trade was just a simple short sale here. So this one did not involve options. This is a short sale, so it does need to be done in a margin account. Remember, this trade was already done during the market session today, as all of my trades are. I sent out the trade information to all of you that are premium members via Telegram. So that's one benefit you guys get before everybody else who watches the free YouTube video later on at night. So with this trade, I did a simple one-for-one reward-risk relationship where I put my stop loss a couple of pennies above the high of this candle back here on September 27th, and then my price target that I'm trying to achieve would be down below here, which would basically be close to the lows of this candle from September 14th. But again, if you need the specific trade details and you're a premium member, that's sitting there waiting for you in the Telegram app. So that's what I have for you. A bearish trade in this case to kind of balance out some of those bullish trades that we have in our portfolio. And if the markets continue to have some difficult days in front of us, then maybe this one can help benefit that that side of the portfolio. So that's what I had for you here today. Again, another big volatile day, so a little bit longer video in this case. We had a lot more things to review and kind of sink our teeth into today. If you got value out of the analysis I just gave you, I ask you one simple request, which is please click like for me there on Twitter. Again, as long as we're getting up and over 100 likes, I don't mind taking 3 hours out of my day to do all the prep work and the video recording and the editing and the notifications and all of that. It's not that big of a deal. If we're getting less than 100 likes, then I question whether it's worth my time to do the video. So if you want to see me do the video again next week, do me a favor and click like there for us on Twitter. Really appreciate that. I hope you guys have a wonderful weekend. David should be back with you tomorrow, and then I'll plan on seeing you all at some point next week. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.